I will not give you any acronyms to memorize. Instead, I will show you the logic behind debits and credits. This way, when you deeply understand the topic and you are able to visualize it, you will never forget it and you'll be able to handle any kind of accounting transaction you might encounter. Hello and welcome to the Accounting Analytics channel. Let's do a small recap on what we said previously. There is a dual effect for each transaction on the accounting equation, meaning for any increase or decrease in an element of the accounting equation, there must be a corresponding increase or decrease elsewhere. Let's say, for example, a company takes a loan from the bank amounting to $10,000. When the company takes a loan, it receives cash. And since cash is part of assets, assets will increase by $10,000. On the other hand, the company now owes an external party an amount of money, specifically a notes payable, since it's a loan. So there will be an increase in liabilities also by $10,000, and now the scale is in balance. So for any transaction, at least two accounts must be involved. And we use debits and credits to reflect the changes in these accounts. For now, all I want you to know is for any transaction, there's at least one debit and one credit, and debits must be equal to credits. Before we delve into debits and credits, let's discuss what is an account. It doesn't make sense for companies to mix different kind of resources they own into one big basket of assets. The same goes for liabilities and equity. This is why each specific element under assets, liabilities, and equity is represented by an account, which is an accounting record of increases or decreases in that element. For example, companies keep separate accounts for cash, accounts payable, notes payable, expenses, revenues, and so on. Each account consists of a title, a left or debit side, and a right or a credit side. It's also called a T account because it resembles the letter T. Let's go back to the accounting equation. Assets are equal to liabilities plus equity. Like the T account, the left side of the equation is normally a debit, and the right side of the accounting equation is normally a credit. What I mean by normal is that if we want to record an increase in the accounts on the assets side, we use debit, or credit if we want to show a decrease. And for the right side of the equation, an increase is recorded with a credit, or debit if we want to show a decrease. Now, in front of any transaction, all you need to do is to determine how will it affect both sides of the equation so we can determine what to debit and what to credit. Let's put that in practice. Mr. Donald invested $5,000 to start a company. Just a quick note here. You recall from the previous video of the Accounting Basics playlist that equity increases with investments. We use an account called capital to record investments by owners. Also, equity increases with the revenues, and the account used is titled revenues. On the other hand, equity decreases with drawings, and we use an account titled drawings. And for expenses, the account is titled, guess what? Yup, expenses. For the sake of keeping the scale illustration simple, I will lump up all of the items that go under equity like capital, revenues, drawings, expenses into a single equity element in the scale. This will help us in remaining focused on the big picture and in keeping the illustration neat. But when recording the transactions on the T accounts, we will use the appropriate accounts. Back to our question. Cash was invested in the business. So cash under assets increased by $5,000 and the capital under equity increased by $5,000. Always, when you are thinking about increases or decreases, imagine this scale and verify that it's in balance. For the asset side, we use debit to record an increase because the normal balance for the assets is debit. And for the equity, we use a credit for an increase because liabilities and equities have a normal credit balance. So we debit cash by $5,000 and the credit capital by $5,000. Number 2. The company bought supplies for $400 in cash. Supplies under assets increased by $400 and the cash account also under assets decreased by $400. Notice we added a new asset or supplies and removed from another asset or cash, so the scale remains in balance. Again, we record an increase for an asset with the debit and a decrease with the credit. So we debit supplies and credit cash by $400. Number 3. Company bought office equipment from IVANKA'S furniture store on account for $2,000. So the company bought an asset. But this time the company didn't pay for the asset in cash. Instead, it was on account. So there's an increase in office equipment on the assets side by $2,000 and an increase in the accounts payable on the liabilities by $2,000. We use debit to record an increase in assets and the credit to record an increase in liabilities. So we debit office equipment and the credit accounts payable by $2,000. Number 4. Company received $3,500 in consultancy fees earned during the month. We have to record a revenue item here. So there's an increase in the cash account by $3,500 and an increase in revenues under equity by the same amount. Again, recall that revenues increase equity. And what do we use to record an increase in equity? What's the normal balance for equity? Yep, you got that right. Revenues are on the credit side because they increase equity. We use debit to show an increase in assets, so we debit cash by $3,500 and credit revenues by $3,500. Number 5. Company paid $800 for office rent. Here, the company paid $800 in cash for the rental expense, and expenses reduce equity. The cash balances decrease by $800 and equity decreased by $800. We use debit to record expenses because expenses reduce equity. So we debit expenses and the credit cash by $800. Number 6. Paid $1,500 to IVANKA'S furniture store on account. Cash balance is reduced by $1,500 and here we paid part of the liability we owe to IVANKA'S store. So the liability is also reduced by $1,500. We use debits to record decreases in liabilities. So we debit accounts payable and credit cash by $1,500. 7. Company used $50 worth of supplies during the month. Here we have an expense, and again, expenses reduce equity by $50. On the other hand, our supplies asset were also reduced by $50. So we debit supplies expense by $50 and credit supplies by $50. Finally, withdrew $260 for personal use. Drawings reduce equity by $260 and the cash account under assets is reduced by $260. So we debit drawings and the credit cash by $260. Here we can see all of the T accounts we used in this practice problem. For each account, we need to compute the ending balance. The balance should be written on the larger side. Let's take the cash T account for example. If we sum up the numbers on the debit side, we get $8,500, whereas the credit side sums up to $2,960. So the ending balance must be on the left or debit side. The balance is determined by netting the two sides. So 8,500 minus 2,960 gives us an ending debit balance of $5,540. And that's it for our video. For your feedback or if you have any questions, leave them down below and I will make sure to get back to you. Thank you for watching and see you later.